Courtyard Talks, Andrew Kuhn, Geoff Gannon. Hope everyone's having a great day. All right, let's talk about the most common question that we get asked by people that subscribe to this. I've already gotten 2 emails by this, and then just people in general on the podcast and on Twitter.
Yeah.
Is how to value companies, right? So let's talk about DCFs.
Okay.
What are your thoughts on DCFs?
I think a DCF is the theoretically correct way to value a company. I think that it's very hard, in fact, to use it that way. And as a result, like, to know what numbers to put into it.
Yeah.
And as a result, I think that it gives you an idea that you know what a company is worth when you don't. But there are, if you break apart a DCF, the pieces you came up with to try to make your assumptions are actually more useful. So, like, if you figure out, here's how much I think this stock will return over time, useful. But DCF that I think, it's worth $150 because interest rates are 4%.
Yeah.
And I put that into my DCF, and I don't agree with that part. The part that's hard about it is that you assume that not only did you get their growth rates right in the future, but you also got the discount rate and all that together, and then you come up with this number and you use that number. I think that the output that you get is not good, but I think the experience of doing it is focusing on exactly the things that matter.
Yeah, and I like to use it to see like what the market could be pricing in. So you do it from like an inverted perspective. If the market's pricing in today 8% growth or this happening, right? Broadly speaking, and you think it could, do better or do worse, is a kind of good way to sort of gauge like what the market's perception of the stock is. Okay, so you said 4%. Mm-hmm. Buffett would never use 4% in a DCF.
Right.
Munger says Buffett doesn't even use DCFs, but he thinks about it from an opportunity cost, which will be the market, right? And most, probably
for a lot of investors, but it should be your next best thing that you could do.
Sure. Okay. Yeah, theoretically. But if you put a 4% discount rate on so many DCFs, I feel like the value is going to look so high. That's a lot of people's argument for the market continuing to go up is because interest rates are basically nothing.
Yeah, but so then that's a good argument. That's perfectly justified.
Yeah.
That stocks could stay up, but what people want to be careful about, here's the thing about that. I think when you turn that into then stocks are worth this much, that's where the problem is. So we're saying sometimes the same thing. Like when I say I'm not that excited about the stock market and stuff going forward, I could be meaning I think it'll return 6% a year. And people will be like, well, but the bonds I could get for that same period of time will be, in government bonds and stuff, will be 3%. So that's pretty attractive.
Yeah.
Well, maybe, but is 6% what you're planning on? And is that what you're going to be living off of and all those sorts of things? I'm not saying that stocks should go down. When I say that, I'm just saying that like they're priced not to offer really great returns going forward. Compare that to the early 1980s or something. Given how high interest rates were, you could argue that it wouldn't take interest rates rising much at all to make a DCF projection of things not look that attractive. Like maybe you should buy bonds. But on the other hand, the stocks were clearly cheap enough that like they would give you good returns. That you knew that you were going to get good returns in them because they were already yielding, over 10% and stuff.
So how would you think about, for people that do like to do the exercise of DCFs or value companies, because you did say it's it is a good tool to use to think about the valuation of a business. You would think about it from like your opportunity cost, right?
So it should be opportunity cost. So if you expect to do as well as the market, it should be how well you expect an index fund to do over a long period of time in the future. So, but so say 15 years or something or whatever it would be. It would depend on what you're comparing it to. There are some other complications that, here's the other thing. When we talk about the percentages and stuff, it also becomes more, as you collect less and less interest, a larger and larger part of the total cash flows that you'll get over time in something are going to be weighted towards the repayment of the thing at the end of the period. So you may also be having things skew further and further from what you think you're comparing them to. Because like a 10-year bond or something now, remember you're getting almost 3/4 or whatever of the total cash flows you're going to be getting at the end of that period.
Sure.
Is the stock worth 3/4 of the stock at the end of the period versus other things?
The terminal value.
The terminal value, exactly. But you're comparing the terminal value on the fact that I'm going to get repaid in this bond, which I agree with you much more on being able to calculate that, than the terminal value on the stock at that point, which becomes a bit of a problem. The biggest reason that I caution people about this is what if interest rates rise while during the time that you're projecting?
Okay.
So that's a really big risk. And the other risk has to do with the reinvestment portion of it, both for the stock and for the bond, that you have to keep in mind, which is those things can change. So, as an example, you might be plugging, like, here's the thing that's confusing me about it sometimes with people, is they're like, so their government bonds will be at 3% a year for the next 10 years while I'm doing this DCF. And my company's going to have a return on invested capital of like 15% or whatever a year. It's hard to reconcile those two things. Okay, because if the risk-free rate is like 3% or something, how is this company able to keep reinvesting at 15% in an economy work this way? If this was really true, all sorts of things would be messed up about the situation. What will tend to happen is those two things are going to have to come closer to each other. And so sometimes I think people are projecting just different things that are kind of hard to believe, that you're going to keep having this amazing rate. Because if that was true, then this company can borrow at 6% a year, even if it's not a great credit, and reinvest at 15 forever. Which might be true, I don't know, but like we're doing things that I think when you plug them in DCF, they sound fine, right? But now when I'm talking about them, I'm like, but what does that mean? Like, what would that mean for the world? You have to think about that, Like, okay, if these are the cap rates on something right now, then that means everyone's waiting 30 years to get paid back, and are they still going to build buildings and stuff to do that? Will the reinvestment be the same in the future as it was in the past this way? And so I think it's important to like consider the actual, like, what that means behind the math. Because exactly that. I see things where people are like, the return on invested capital is going to be 15%, and yet the risk-free rate is going to be 3%. But if that's true, a company should borrow just to do every project that they can think of. Every project they could imagine right now is a better return than what their cost to borrow would be. So the company should instead, do all of that.
What about, I've seen some investors, they'll use like an arbitrary number, like a 10.5% discount rate across every situation. Does that sort of hedge against that, what you're saying?
Yeah, so I think the rate you should use is not the risk-free rate. I think it's the rate that you should, to compare stocks to other stocks, is the rate you expect in the index.
Okay, so let's say you think you just said 6%.
Right.
And then if you're managing money, maybe you tack on a fee on top of that. So you think about purely from an opportunity cost perspective.
Right, yeah. But I don't think it can be a hurdle rate that you need to hit. If you're charging money for something, well, that just comes out of what's happening. I mean, pension funds and stuff have that issue. It's whatever you can get best next. Now, I would use a much higher hurdle rate than what I expect the index to be.
Okay, so like
because I would use more like a rate that I've made historically. So since I started investing. So, and that rate's a lot higher than the index. So you could be using a discount rate that's almost 10 points higher than the index. But that's what I would use until I learn from experience that I'm not able to pick those things. But as long as I am, if your historical experience with the ideas you found and invested in has been, let's say it's been 15% or whatever. If it's been 15%, then until you start seeing strong evidence that you can't find 15% ideas in the future, you want to like sit on cash a little bit and stuff. You don't want to jump into something just because it's better than government bonds. Because when we're doing this risk-free rate and stuff, all you're saying is it's better than government bonds. I don't disagree with you. It is better than government bonds, but keep looking harder. That doesn't mean that you should buy it at that price. And it may be that that's the intrinsic value of the stock. But that's very different than saying, should I buy it? And to be honest, I think the thing you need to know is, should I buy it? I don't think you need to know the exact intrinsic value of something. I think you need to know, is this a mistake to buy this thing? Or is this kind of in line with some of the best investment ideas I've made in the past? Or at least the best things I can do right now.
Yeah, it's like when Buffett says you don't need to know a man's weight to know he's fat, right?
Exactly.
So we don't, so maybe we think through, obviously the future cash flows and everything, but we discount back, so we do a little bit differently. Right. So maybe explain that process. Why do we do that? And how you typically think about valuation of a company.
Yeah, so I mean, one way to think about it is if you're tying up money over time, you need to get a return on that. And the question is that return as good as like what you could get elsewhere, right? So for instance, if just as an example, and this is the same way that discount rate works, but just as an example, let's say I have a stock that's got a 10 PE and I think it'll go to a 20 PE. Okay. But it's growing at 10% a year. Okay. Well, if it's growing at 10% a year and I think that I can't do much better than 10% a year in an index, then in essence, I'm not losing anything by waiting for the re-rating from 10 to 20. Okay? I'm not paying anything, I'm getting that 10% growth a year. So I'm okay that way. And it's the same sort of thing that would be true whether it's an asset play thing like we just said, or something else. So as an example, like take the examples of like Cool, the Timberland Company, or more Maui Land and Pineapple, MLP, they don't make any money in cash flows each year. So when you do the math, all you get is the increase in their land values. Now there is some increase in land values, but if you think the S&P 500 will do better than the increase in land values, then in essence your costing yourself money by tying up a capital.
Sure, yeah.
So let's say you think that the S&P 500 will go up 7% a year for the next 15 years, and landed value will go up 3% a year. Then basically you're behind 4% a year by being in the stock than in the S&P 500. But that can be made up if it doubles within, if it doubles within like 10 years or something, it'll make it up. But if it doubles within 15 or 20 years, it won't. That won't justify it. So you can do it that way, like you were saying, reverse DCF by figuring that out. Yeah.
Cool. Well, thank you so much for being a subscriber. If you're watching this on YouTube, this is a good topic. Everyone's always looking for DCF, so it's clickbait. So I'm gonna make this a public video. So thank you so much, and hit that subscribe button. If you're not subscribed to the app, make sure you do that. Go to focuscompounding.com/app. We pump a ton of videos just like this, and you get access to our 200+ episode backlog of the podcast and multiple frequent 2,000 word write-up, 2,000 word plus.
They're not write-ups to specific stocks, though.
No, not specific stocks.
They're just articles on investing, yes.
Investing topics just like this. So check it out, focuscompounding.com/app. Thank you so much for the support, and we will see you in the next video.